Hello, and a very warm welcome to all of you, my dear friends and fellow traders. I'm so excited to have you here for another critical and fascinating lesson. Let's begin with a familiar feeling of confusion that has shaken the heart of every trader at least once. You look at the 4-hour chart and see a magnificent, powerful uptrend that is screaming by me. You confidently enter a long trade, but to your disbelief, the price immediately and forcefully moves in the opposite direction, stopping you out for a loss. You ask yourself, how is this possible? The trend was clearly up. This feeling that the market is fighting with itself stems from a deep truth. In the ocean of the market, there are always two currents moving simultaneously. There is a deep, powerful, and slow current that we call the trend, and there is a surface level, fast and choppy current that we call the order flow. The problem is, these two currents do not always move in the same direction.
Before we can understand the turbulent surface level current of the order flow, we must first define our position relative to the deep primary current, the trend. The trend is the king of market movement. The trend is our overall long-term direction, telling us whether the primary power is in the hands of the buyers or the sellers over a multi-week or multi-month perspective. To ensure our analysis of this concept is clear and unambiguous, we will establish a simple rule for ourselves. We define and analyze the trend only on higher time frames, such as the 4-hour or the daily chart. The trend is like a fixed and unshakable North Star in the sky of our analysis. This star shows us the general direction of our journey, but it doesn't necessarily define our winding path from moment to moment. Understanding this concept is the first step to freeing ourselves from daily confusion.
Now that we have found our North Star, the trend, it is time to address the surface waves and the exciting story of the markets now. Order flow is the answer to the question. At this very moment, in this very hour, who is in control? Order flow is the short-term narrative of the market, the story of the small battles, the pullbacks, and the corrections. And here is the vital point. The order flow can, and often does, move in the complete opposite direction of the main trend. Our main trend on the 4-hour chart might be a powerful uptrend, but for the last few hours, the order flow on the 15-minute chart could be completely bearish as the price is in a correction. This contradiction is the blind spot for many traders. They either only see the trend or only see the order flow, and they lack the ability to comprehend this duality.
All right, so how can we identify these shifts in the short-term flow of orders? The clearest and most reliable signal for a change in order flow is the, quote, break of the last valid short-term structure. Let's use an example. Imagine our main 4-hour trend is bearish, but the price is currently in a bullish pullback on the 15-minute time frame, making a series of small higher highs and higher lows. In this state, our short-term order flow is bullish. We watch patiently. The moment the price breaks the last valid quote-unquote low in that 15-minute uptrend to the downside, that is an extremely powerful signal for us. It means the short-term bullish order flow has run out of steam, and the bearish order flow, which is now realigned with our main 4-hour trend.
Before we can understand the turbulent surface level current of the order flow, we must first define our position relative to the deep primary current, the trend. The trend is the king of market movement. The trend is our overall long-term direction, telling us whether the primary power is in the hands of the buyers or the sellers over a multi-week or multi-month perspective. To ensure our analysis of this concept is clear and unambiguous, we will establish a simple rule for ourselves. We define and analyze the trend only on higher time frames, such as the 4-hour or the daily chart. The trend is like a fixed and unshakable North Star in the sky of our analysis. This star shows us the general direction of our journey, but it doesn't necessarily define our winding path from moment to moment. Understanding this concept is the first step to freeing ourselves from daily confusion.
Today, we are going to talk about one of the most common and frustrating problems that traders face: getting stuck in the internal range. Imagine the market is fluctuating between a confirmed high and a confirmed low. In this area, the price moves up and down with fast and deceptive movements, creating weak and invalid highs and lows, and it seems to have no specific logic. The truth is, this area is a war zone and a dangerous quicksand. The market in this zone is only building liquidity. That is, by breaking these weak highs and lows, it is activating the stop losses of impatient traders and turning them into fuel for its next move. Trading within this chaotic range is one of the most difficult and riskiest things possible, and as smart traders, we must learn to stay away from this quicksand.
Now, where does the main problem begin? A trader might be smart enough to identify this internal range on the 15-minute time frame and avoid it, but they commit a very big and fatal mistake that I call the fractal error. They forget that perhaps the entire 15-minute chart they are looking at is itself just a tiny piece of a much larger internal range on the 4-hour chart. They see a small break of structure on the 15-minute chart and excitedly think that a major trend change has occurred, while in reality, this break is just meaningless noise within that 4-hour quicksand. This inability to see the bigger picture, that is, not seeing the forest for the trees, is the root of many trading losses.
So how can we escape this fatal error? The solution is to adhere to a simple but unbreakable rule. A main trend only truly and definitively changes when its extreme zone, that is, the highest high in a downtrend or the lowest low in an uptrend, is broken. Any other break that occurs in the middle of the path and in the internal decisional zones is not a definitive trend change. Rather, it is just a potential change in the order flow or the short-term flow of orders. Understanding this difference between a trend change and an order flow change is the main key to achieving a clear and unambiguous analysis. We must always first respect the bigger picture and the kingdom of the extreme zones.
Now, let's review the workflow of a professional trader together. Step 1, we see that our main trend on the 4-hour time frame is bullish, but the price has hit a very important supply zone on that same higher time frame. This is the context of our analysis. Step 2, we go down to a lower time frame, for example, the 15-minute chart. Step 3, we patiently wait until the short-term uptrend on the 15-minute time frame shows a change of character or a break of structure to the downside. This change of character is now a very powerful and valid signal. Why? Because this event occurred as a direct reaction to that higher time frame supply zone. This is the correct method of combining time frames to find a reliable order flow change.
Now that we have a valid signal indicating a change in order flow to the downside, while our main 4-hour trend is still bullish, what can we do? Here we enter a more advanced field called counter-trend trading. We can go along with this new bearish order flow and look for selling opportunities. But we must know that this is like swimming against a powerful river. It is possible, but it requires precision, skill, and a very clear exit plan. We must accept that we are taking a riskier trade. And for this reason, we must act with more caution and absolutely no greed.
When we decide to take a counter trend trade, we must establish a set of strict rules for ourselves. Rule number one, greed is forbidden. Since we are fighting in enemy territory, we cannot have big targets. When we enter a short position based on the 15-minute bearish order flow, our first take profit target must be the first valid demand zone that we see in our path on that same 15-minute time frame. Rule number two, reevaluation. As soon as the price reaches that demand zone, we must take a large portion of our profit off the table and reevaluate the situation. We do not, under any circumstances, assume that the price will continue its decline. We wait to see if that demand zone has the power to hold the price or if it is going to be broken. This step-by-step trading approach is the key to survival in counter trend trades.
In the end, all these discussions lead to a single conclusion. The ultimate solution to the biggest problem in trading, getting lost in the market noise, is a disciplined, top-down structural analysis. This is a hierarchy of power. First, we understand the main higher time frame trend and its extreme points. Second, we identify the important supply and demand zones on that time frame. Third, we wait for the price to react to one of these important zones. Fourth, we go down to a lower time frame and look for a change in the order flow as our confirmation signal. And fifth, if we are trading counter trend, we manage our trade with iron discipline and on a step-by-step basis. This structured approach is what transforms a chaotic chart into a clear map and a confused trader into a confident strategist.
Going to address one of the most critical and, at the same time, most dangerous concepts in structure analysis, the internal range on a higher time frame. Imagine our 4-hour chart is trapped between a strong, confirmed high and a confirmed low. Within this massive range, the market acts like a raging river full of whirlpools. If you go down to the 15-minute time frame, you will see the trend reversing again and again. It's bullish 1 hour, bearish the next, constantly leaving you confused. The truth is, all of these movements on the lower time frame are just noise and maneuvers to build liquidity within that larger 4-hour internal range. Trading within this labyrinth of traps carries an extremely high risk. A professional trader, before anything else, identifies this large range and patiently waits for the price to exit it.
So, if trading in an internal range is dangerous, when can we confidently say that we are trading in the direction of a healthy and reliable trend? The golden rule of alignment comes to our aid here. A high probability trade is formed only when the order flow on our lower time frame, e.g. 15-minute, becomes aligned and in harmony with the trend on our higher time frame, e.g. 4-hour. But this harmony requires a very important condition. This event must occur after the price has first hit a very significant supply or demand zone on the higher time frame. This means we wait for a reaction from the big players on the higher time frame, and then we look for confirmation of that reaction in the movements of the lower time frame. This synergy between the time frames is the basis of a powerful and logical trading strategy. Let's look at these concepts on a real chart with a practical example. Imagine we are watching a powerful uptrend on the 4-hour time frame. Suddenly, the price begins to fall sharply, but when we look at the history of the 4-hour chart, we can't find any clear supply zone at that point. This is the exact moment a novice trader gets confused. But a professional trader knows that to solve this puzzle, they must appeal to a higher authority. They go to the daily time frame, and there they find the answer to the puzzle. Our 4-hour price had perfectly hit a powerful daily supply zone. This teaches us a very important principle. Just as the movements of the 15-minute time frame are influenced by 4-hour zones, the movements of the 4-hour time frame are influenced by daily and weekly zones.
Now that we understand the main reason for the price reversal was hitting that daily supply zone, it's time to act like a detective and look for clues on the lower time frames. We want to find the exact moment the power shifted from the buyers to the sellers. So we go to the 15-minute time frame. After the price hit that daily zone, we carefully monitor the movements on the 15-minute chart, and we see that the price comes down and breaks its last valid bullish low with force. This is our golden moment. This means the order flow has officially changed from bullish to bearish. Now we have a very powerful signal, a reaction from a higher time frame zone, daily, that has been confirmed by a change of character on a lower time frame, 15-minute.
We are now in a very interesting situation. Our main 4-hour trend is still bullish because its extreme low has not been broken, but our 15-minute order flow is completely bearish. This means we are in a deep corrective phase within the larger uptrend. Can we trade this bearish move? Yes, but this is a counter-trend trade and requires special management. The most important question is, how far will this bearish move continue? This move has a logical and predetermined destination, and that is the first valid 4-hour demand zone that lies in its path. So we can go along with the bearish order flow, but we know that our journey will end near that 4-hour demand zone.
The price, after traveling its bearish path, finally reaches our 4-hour demand zone. Now everything is reversed. We are now waiting for a buy signal. We look at the 15-minute time frame and wait for a bullish change of character. The price makes a small upward move and breaks a tiny high. Is this our signal? A professional trader looks more closely and sees that this move was weak and lacked power and created no imbalance. They ignore this signal, and they were right to do so, because the price comes back down again, even breaking the previous low and stopping out the impatient traders. This teaches us that we are not looking for just any break. We are looking for a powerful and convincing break.
After that weak and deceptive break, the price makes another move downwards, but in the end, the buyers enter the scene with much greater force, and this time they create a very strong, clear, and powerful break of structure to the upside. This is the signal we were waiting for. This is the final confirmation that shows the big players at that 4-hour zone have now taken control of the market on the lower time frame as well. Now we can enter a long position with much greater confidence. Let's review the whole story. A daily zone caused a 4-hour reversal. This reversal created a 15-minute order flow shift. The price traveled to the opposing 4-hour zone, and there a new 15-minute order flow shift gave us our final entry signal. This complete multi-layered story is the essence of professional market analysis.
In market analysis, nothing is ever truly destroyed. It is merely transformed from one form to another. Let's examine a very important scenario. Imagine we have a powerful demand zone on the 4-hour chart that has been pushing the price upwards. But eventually the seller's strength becomes so overwhelming that this demand zone is broken and ceases to exist. Is the story over here? No. This is just the beginning of a new story. The same powerful bearish move that caused the failure of our demand zone in its very creation gives birth to one or more brand new invalid supply zones. We now have a new extreme supply zone at the origin of the move and possibly a few decisional supply zones along the path. This means that from the ashes of a failed zone, completely new trading opportunities have been born for us on which we can plan for the future. This cycle of life and death of zones is the fundamental dynamic of the market.
Now let's follow a complete trading cycle together. The price on the 15-minute time frame is in an uptrend. This movement continues until it collides with one of those newly created 4-hour supply zones that arose from the previous failure. This is the moment of truth. We look closely at the 15-minute chart and wait for a reaction. As expected, the selling pressure from the higher time frame zone makes its presence felt on the lower time frame, and we witness a clear change of character to the downside. The order flow has now officially turned bearish. We now have a counter trend trading opportunity. What is the target of the sell trade? The first valid 4-hour demand zone located at the bottom of the chart. After some time, the price reaches this demand zone and we close our sell trade with a profit. But our work is not done. The next phase of our analysis is just beginning.
In the real world of trading, the market doesn't always act like a precise robot.
Sometimes you will see the price come within a few pips or even less of your zone and then reverse without ever touching it. A rigid and inflexible trader in this moment misses the opportunity.
But a professional and experienced trader knows that the price feed can vary slightly between different brokers. The professional's rule is this: if the price gets very close to your zone and then produces a very clear and powerful change of character on the lower time frame, you can consider it a valid reaction and enter the trade. We are looking for the logic of the move, not just the touch of a specific number. This mental flexibility will save you from missing many excellent trades.
Let's return to our scenario. The price has reached our 4-hour demand zone. We are now once again waiting for a change of character. This time to the bullish side on the 15-minute time frame. After some fluctuation, this happens, and we see a powerful bullish break of structure. This is our entry signal for a buy trade. Now that we are once again aligned with the main 4-hour trend, our targets can be much larger and more ambitious. Our first target could be the previous 4-hour high. But where is our ultimate target? We zoom out the chart, look at the higher time frames, and identify the first major 4-hour or even daily supply zone that sits high above the price as the final destination for this bullish move. This comprehensive view allows us to utilize the full potential of a major move.
Now let's look at the current edge of the market and based on all this knowledge, predict the next moves. We can see that the price is currently stuck in a small internal range. Scenario 1, bullish. The most likely scenario is that the price will make a small move down, reach the first valid 15-minute demand zone, give us a bullish confirmation there, and then begin its main move towards those long-term targets on the higher time frame. Scenario 2, corrective. If the price breaks that first demand zone, we can take a short-term sell trade down to the next demand zone. And the final rule, as long as the main 4-hour extreme low is not broken, our overall bias remains bullish. This ability to map out scenarios based on a structured framework is the pinnacle of a technical analyst's skill.
Our entire trading methodology begins with building a grand blueprint of the market, which requires a deep understanding of its true structure. The most critical lesson is learning to differentiate between the two powerful currents of the market: the deep, slow-moving and powerful higher time frame trend, and the fast, choppy, and emotional lower time frame order flow. We learn to avoid the fractal error, the fatal mistake of misinterpreting the chaotic noise within an HTF internal range as a genuine trend change. The unbreakable rule that acts as our North Star is this: a true long-term trend is only considered broken when its extreme high or low is violated. This hierarchical understanding, respecting the HTF trend above all else, is the foundation that brings clarity to the apparent chaos of the charts and prevents us from being swept away by the short-term waves that go against the main current.
Once we understand the market's general direction, our next task is to find the specific locations on the map where treasure might be buried. We learn to move beyond subjective line drawing and utilize pivot points, the objective, mathematically calculated levels that the market's largest institutions watch closely. We explored the hierarchy of power between daily, weekly, and monthly pivots, understanding that the higher the time frame, the more significant the level. But the true art lies in finding confluence. This is the master technique of layering these different maps on top of each other. We learn to hunt for those magical super levels, a price point where a key structural zone, like an H4 demand, aligns perfectly with a major pivot level, like a weekly S1. These confluence zones are the highest probability areas on the chart, the points where the market is most likely to have a powerful and predictable reaction.
With our high probability zone identified, we then focused on the critical moment of execution, the entry. We built a complete arsenal of entry tactics, each suited for a different personality and market condition. We covered the classic change of character Chach-based entries, including the precise return to origin, the more forgiving 50% pullback, and the clever split entry model. We then delved into more advanced concepts, learning how to read the market's deeper intentions by identifying flip zones and avoiding the inducement IDM trap. Finally, we explored the most predatory entry style, the liquidity sweep, where we enter after the market has hunted the stops above or below a key level. The golden rule for all these techniques remains the same. They are only valid as a reaction to a significant higher time frame point of interest.
Ultimately, all the technical analysis in the world is useless without an unbreakable code of discipline. We established that the final step before any trade is the non-negotiable pre-trade checklist, defining our invalidation point, stop loss, setting a logical target, and ensuring the potential reward is at least 3 times our risk. We contrasted the 2 core risk philosophies, the patient 2-bullet sniper who waits for the perfect shot versus the high-frequency scalper who operates with a strict daily loss limit. Finally, we learned that the ultimate goal is not to find a secret system, but to use rigorous backtesting and journaling to build a personalized strategy that reflects our unique personality. The true path to consistency lies in this deep self-discovery and the iron discipline to follow the rules of the system that we ourselves have forged.
We have learned how to identify the direction of a trend. We know when the market is bullish and when it is bearish. But there is a much deeper and more critical question. How do we know when a trend is getting tired? How can we tell when the energy and fuel of a bullish or bearish move are running out? Prices do not move in a straight line forever. Every trend, no matter how powerful, eventually loses its energy, runs out of breath, and needs to either rest or even change direction entirely. One of the biggest mistakes a trader can make is to enter a trade at the exact moment that the trend is at its peak of exhaustion. Today we're going to get acquainted with a special class of tools that act like an energy meter or a fuel gauge for the market. These tools help us read the hidden story of the market, the story of its energy and its fatigue.
The term non-momentum oscillator might seem strange at first. Don't all oscillators in one way or another deal with measuring, quote, momentum or the acceleration of price? Yes, but there is a subtle and very important difference. While classic momentum oscillators focus more on the strength and direction of a trend, non-momentum oscillators measure how, quote, stretched or overextended the price is relative to its own recent average. To understand this better, imagine a, quote, rubber band. Assume the price is attached to its average price by a rubber band. The further and faster the price moves away from its average, the more this rubber band is stretched. Non-momentum oscillators measure exactly how stretched this rubber band is. And we know that when a rubber band is stretched too far, the probability of it snapping back towards its equilibrium point increases dramatically.
These oscillators give us 2 very important signals that can be understood through our rubber band analogy: overbought and oversold. Overbought does not mean sell immediately. Rather, it means that the buying pressure in the market has been so intense and relentless that the buyers are running out of breath and the market has become very expensive. In this condition, our rubber band has reached its maximum stretch at the top of the chart, and the market is very vulnerable to a pullback to the downside or at least a period of rest. Oversold is the exact opposite of this state. This signal doesn't tell us to buy immediately. Rather, it says that the selling pressure has been so extreme and ruthless that the sellers are getting tired and the market has become very cheap. Our rubber band has reached its maximum stretch at the bottom of the chart and the market is perfectly ripe for a bounce to the upside.
Now we arrive at the most powerful and professional signal that we can get from these oscillators.
Divergence.
Divergence occurs when the price and the oscillator tell 2 completely different stories, and this is a very, very serious warning. Imagine on the price chart you see a new low that is lower than the previous low, a sign of a continuing downtrend. But when you look at your oscillator, you see with amazement that the oscillator has made a higher low than its previous low. What does this mean? It means that even though the price has gone lower, the energy and power behind this bearish move have drastically decreased. The sellers are losing their power, and this is a very strong signal of a probable major reversal to the upside. Divergence, like a fortune teller, shows us the likely future of the market before it happens on the price chart.
In this lesson, we will take a deep dive into the world of some of the most famous non-momentum oscillators, like the stochastic oscillator and Williams %R. We will learn in simple terms what their calculation formulas are, how we should interpret their various signals, overbought, oversold, and divergence, and most importantly, how we can build specific and executable trading strategies based on these signals. By the end of this lesson, you will no longer just look at the price, you will be able to see the hidden energy, fatigue, and internal strength of the market. You will learn to spot when a trend is losing its power before the rest of the market notices, and this will give you a tremendous edge in timing your entries and exits.
In the world of technical analysis, we deal with a wide variety of tools called oscillators. But to avoid confusion, we must understand that all these oscillators are divided into two main and completely different families. The first family is the famous and populous momentum family. Tools like the momentum indicator itself, RSI, MACD, and stochastics are all members of this family. What is the main job of this family? They act like a speedometer for the market's engine, measuring the intensity and acceleration of price movement for us. For example, they show us whether the buying pressure is high enough to push the price upwards with force, or if, despite the price increase, the acceleration and energy of the move are decreasing. This family gives us information about the power and health of a trend.
The most powerful signal we get from the momentum family is the concept of divergence. Divergence tells us the story of a trend getting tired. Imagine the price is making a new high that is even higher than the previous high. On the surface, this is a sign of a strong uptrend. But when we look at our momentum oscillator, we see that the new peak in the oscillator is lower than its previous peak. What does this mean? It means that even though the price has gone higher, the acceleration and energy behind this move have drastically decreased. The buyers no longer have the same power as before. This contradiction between the movement of the price and the movement of the oscillator is a very serious warning, telling us that this trend is likely reaching the end of its life and we should expect a reversal or a deep correction. In reality, all the oscillators in the momentum family, with their different mathematical formulas, are telling us this same story of divergence.
Now that we are familiar with the first family, it's time to move on to a second family, the non-momentum or filter oscillators. These oscillators are usually seen less often at the bottom of a retail trader's chart, but they play a very vital and different role. The job of this family is not to measure the acceleration of the price. Their job is to answer a very simple and key question. Are the current market conditions suitable for trading or not? They act like a filter or a gatekeeper, and before we even think about finding a trade setup, they tell us whether it's even worth spending our time and energy analyzing this market or if it's better to move on to another chart. These oscillators don't give us buy or sell signals, they give us trade or don't trade signals.
The first and one of the most important members of this filtering family is an indicator called ATR, or average true range. The job of this indicator is very simple. It measures the, quote, volatility of the market. ATR doesn't care about the direction of the price. It doesn't matter to it whether the price is bullish or bearish. It only tells us whether the market is currently energetic and volatile, or if it's in a state of sleepiness and inactivity. In fact, ATR acts like a heart rate monitor for the market. When the ATR line goes up, it means the market's heartbeat is fast and the fluctuations are severe. When the ATR line goes down and moves flat, it means the market's heartbeat has slowed and the market is in a state of indifference and calm.
Now, why is measuring this volatility so important to us? Because trading in a market with very low volatility, or a so-called dead market, is one of the most dangerous things possible. Imagine you're sailing, even if you have the best map and compass in the world, if there is no wind, your boat will not move from its place. The market is exactly the same. Trading volume and volatility are the sails of our boat. If the volume of money in the market is low, which shows itself with a low ATR, even the best and most beautiful chart patterns will not work. You might find a perfect triangle pattern, but because there are no buyers to push the price upwards, that pattern will most likely fail and you will face a loss.
So what is our strategy for using ATR? It's very simple. We use ATR as a do not trade filter. We can define a rule in our trading strategy for ourselves. If the value of ATR on the chart I am analyzing is below a certain level, I am under no circumstances allowed to open a trade on that chart, even if I see the best possible setup on it. This simple rule saves us from wasting time, capital, and mental energy on opportunities that have a low chance of success from the very beginning. This filter helps us to only look for opportunities in markets that are alive and energetic, which means a significant increase in the probability of our trade success.
In the end, we arrive at a deep understanding of professional trading. The edge of a successful trader is not just in finding good entry signals, it is in building a powerful filtering system that tells them when to stay away from the market. A complete strategy combines both families of oscillators. The trader first uses filtering tools like ATR to check if the overall market conditions are even suitable for trading. If the answer is yes, then they move on to the momentum family, like RSI or MACD, and price action analysis to look for a divergence or a precise entry signal. This layered and disciplined approach, first checking the condition of the playing field and then choosing an attack tactic, is the hallmark of an experienced and consistently profitable trader.
Before a professional trader even bothers to look for a trade setup, they ask one fundamental question. Is there enough life, enough energy, enough money flowing through this market to even be worth my time? This question is our first and most important filter. We can answer it by using the ATR indicator. We can define a rule for our trading system, instructing our own minds. If the ATR value on a particular chart is below a certain threshold, meaning the volume and volatility are very low, we are to ignore that chart completely and not receive any signals from it. Because a trading opportunity is only truly ready when a high volume of money is being exchanged within it. Otherwise, we are simply wasting our precious time and energy.
Now let's examine the opposite scenario. What does it mean when the ATR value reaches its peak and becomes very high? A high ATR tells us that a very special and significant event is happening in the market. When do market fluctuations drastically increase? They increase when a major economic news report is released.
when a geopolitical crisis occurs, or when a long-term uptrend has reached the end of its life and begins to correct with a giant bearish candle. In all of these situations, a very high volume of money is exchanged between buyers and sellers, and this causes severe price volatility. These intense fluctuations manifest themselves to us in the form of a high ATR. So, when we see a big spike in the ATR, we know we must be on high alert because the market is in an emotional and high potential state.
You might think that the formula behind ATR is very complex, but in reality, it is both simple and intelligent. To measure the quote-unquote true volatility of a candle, ATR calculates 3 different values. Number 1, the distance between today's high and yesterday's closing price. Number 2, the distance between today's low and yesterday's closing price. And 3, the distance between today's high and today's low. Then from among these 3 numbers, it chooses whichever is the largest as the quote-unquote true range for that day. This method ensures that even if there are price gaps between 2 days, ATR includes them in its calculations. Finally, ATR takes an average of these true range values over a specific period, which is usually 14 by default, and plots the line that we see on the chart.
That number 14 you see by default next to the ATR is its averaging period, quote unquote. Understanding the role of this number is very important. This number acts like the sensitivity knob on our volatility meter. If you feel that a 14 candle period is too long and slow to react to a decrease in volatility, you can reduce this number. For example, if you change it to 9, your ATR will react much faster and with a steeper slope to changes in volatility. When the market becomes calm for a few consecutive candles, an ATR with a period of 9 will fall much more quickly and give you an earlier warning. The choice of this number depends entirely on your strategy and trading style. A short-term trader might use shorter periods, while a long-term trader might prefer the standard 14 or even higher.
Here we arrive at a very, very important point. Why don't we typically place the ATR indicator at the bottom of our chart to trade off of it, like we do with RSI or MACD? The answer is simple. Because ATR gives us zero information about the direction of the move. It is completely blind to direction. A huge spike in the ATR could be caused by a giant green candle, a sharp upward move, just as easily as it could be caused by a terrifying red candle, a sharp downward move. ATR only tells us that something happened, but it doesn't tell us whether we should buy or sell in reaction to that event. For this reason, we do not use ATR as a direct signaling tool, but rather as a powerful filter for assessing the market's condition and environment.
There's an interesting psychological insight related to ATR. Often, when the ATR value reaches its peak, the market subsequently enters a resting phase or a corrective move. Why? The logic is simple. Remember that ATR is an average. For the ATR value with a period of, say, 9 to reach its peak, it means that the last 9 candles have, on average, been consecutively very volatile and energetic. Now, after 9 consecutive large energetic candles, what is the most likely next event? exhaustion. The market no longer has the energy to continue that explosive move and needs to take a breath and refresh. This is why we often see a calming of the price and even a short-term reversal after seeing a peak in the ATR. This helps us avoid entering a trade at the peak of excitement and at the end of a move.
So far, we have understood that ATR tells us if the market is energetic and tradable. But a big problem remains. ATR doesn't tell us if this high energy and volatility is part of a strong defined trend or if it's just directionless, chaotic, choppy price action. These two situations are completely different and require completely different strategies. So our next logical question is, how can we know if the market is both highly volatile and in a strong trend? To answer this question, we need a more advanced tool that actually uses ATR as one of its building blocks. This tool, which we will discuss next, helps us measure not only the amount of energy, but also the quality and strength of the trend itself.
One of the most fundamental yet difficult questions that every trader must answer every single day is this: is the market I'm looking at moving with a powerful directional trend, or is it in a state of confusion, fluctuating sideways in a range? Answering this question is vital. Why? Because the strategies that lead to incredible profits in a trending market will lead to consecutive losses and the destruction of your account in a ranging market. Distinguishing between these two states by eye can sometimes be very difficult and subjective. Today we are going to get acquainted with a very powerful and mechanical tool called ADX, Average Directional Index, whose main job is to answer this very question with mathematical precision. This tool tells us whether there is even a trend worth trading or not.
When we add the ADX indicator to our chart, we are faced with 3 colored lines, each of which tells a different story. The green line, plus DI. This line is the bullish army strength meter. The higher this line is, the more pressure and power the buyers have in the market. The red line, minus DI. This line is the bearish army strength meter. The higher this line is, the more selling pressure and power the sellers have. And finally, the main line and commander-in-chief, the black line, ADX. This line doesn't care which army is winning. Its only job is to measure the overall intensity of the battle. If this line is high, it means an all-out war and a powerful trend are underway. If it's low, it means the market is in a ceasefire and a boring range.
All right, let's assume the black ADX line is above the 25 level and has given us permission to enter the battlefield. Now, how do we determine the direction of the trend? Here we turn to the other 2 lines, the green and the red. The rules are very simple. Buy signal. If the black line is above 25 and at the same time the green line plus DI is above the red line minus DI, this is a clear signal for a bullish trend. In these conditions, we only look for buying opportunities. Sell signal. If the black line is above 25 and this time the red line, the minus DI, is above the green line plus DI, this is a clear signal for a bearish trend, and in these conditions we only look for selling opportunities. Just like that, by combining these 3 lines we can both be sure of the existence of a trend and determine its direction.
Let's see these rules on a real chart. Imagine for days the ADX line has been fluctuating below the 25 level, and the price has been stuck in a boring, ranging area. We, with complete discipline, have not made a single trade. Suddenly, we see the black ADX line powerfully cross above 25. We immediately look at the other two lines and see that the green line has powerfully crossed above the red line. This is our signal. The uptrend has begun. We enter a long position and see that as the price grows, the ADX line also continues to rise, sometimes reaching incredible levels like 60 or 70, which indicates an extremely powerful trend. As long as these conditions hold, we can comfortably stay in our trade and enjoy the profit.
In the end, let's have a final summary about the ADX. It is an incredibly quote-unquote cool and practical oscillator. Its greatest strength is its unparalleled ability to filter out ranging and non-trending markets. This feature alone can save us from entering dozens of wrong and loss-making trades, which is a tremendous advantage. When ADX is above 25 and shows us a trend, we can trade in that direction with very high confidence. Its weakness is its slight delay in showing reversal points. Therefore, we conclude that ADX is not a complete trading system on its own, but it is an essential and vital tool in the toolbox of any professional trader, helping them to confirm the most important condition for success, the existence of a quote-unquote trend.
We have seen the power of the ADX indicator in identifying the existence of a trend. It tells us if the market is directional or ranging, and with its green and red lines, it even shows us the direction of that trend. So can we just use this indicator by itself to trade and consider it a complete trading system? The answer is an emphatic no. The biggest weakness of the ADX is its lag. Because this indicator is based on moving averages, it is always a few candles behind the actual price. This means you cannot rely on it to predict the exact turning points of the market. The ADX is an outstanding confirmation tool that shows us the context and environment of the market. But to get precise entry and exit signals, we must use other, more leading tools alongside it.
Now that we understand the limitations of ADX, let's move on to a completely different oscillator that follows another philosophy, the parabolic SAR. This indicator is one of the most beautiful and visual tools in technical analysis. When you add it to your chart, you will see a series of green or red dots that, like a shadow, follow the price. Interpreting this indicator is wonderfully simple. The rule is this: as long as the green dots are below the price candles, the market is in a powerful uptrend. But as soon as these dots jump above the price candles and turn red, it is a clear signal that the trend has changed to bearish. This visual simplicity has made the parabolic SAR a very popular tool for quickly identifying the direction of the trend.
But this beautiful simplicity has a very large and fatal flaw. The parabolic SAR is a completely quote-unquote trend-following tool. This means that in a trending and directional market, its signals are incredibly accurate and profitable. But as soon as the market enters a quote-unquote ranging and trendless phase, this indicator goes completely crazy. In a ranging market, you will see the parabolic SAR dots constantly and confusingly jump from bottom to top and top to bottom, issuing dozens of false buy and sell signals. So how should we prevent this weakness? The solution is quote-unquote combination. We must filter the signals of the parabolic SAR with a trend strength indicator like the ADX.
Our rule is this. We only pay attention to the parabolic SAR signals when the 80x line is above the 25 level.
A professional trader uses the color change of the parabolic SAR dots only as a confirmation that the trend has turned bearish, not as an entry trigger. After seeing the dots turn red, they wait with patience. They don't care about the initial price drop. They wait for the price to make a corrective move upwards and get close to those red dots, which are acting like a dynamic moving ceiling above the price. This is exactly like the strategy of entering on a pullback to the moving averages. As soon as the price gets near these red dots, they enter a sell position with a very small stop loss, just a little above the SAR dots themselves. This method gives us an incredibly optimal entry point with an excellent reward to risk ratio and transforms the parabolic SAR from a simple indicator into a professional tool for low risk, intelligent trend following entries.
We have learned a powerful low-risk entry technique using the parabolic SAR pullback. But entry is only half the battle. A professional trader's first question is always, where do I get out? This is the biggest limitation of the parabolic SAR. While it can brilliantly signal the start and direction of a trend, it provides absolutely no information about where that trend might end or where to take profit. It's like having a car with a fantastic accelerator but no brakes. It can get you going fast, but it can't tell you where the destination is or when to stop. Therefore, to turn this into a complete tradable system, we must combine it with other tools that are specifically designed to help us define our exit points. This is where the true art of strategy building comes into play.
To solve the exit puzzle of the parabolic SAR, we must pair it with other tools that are adept at identifying potential stopping points. What are our options? We can use the objective, mathematically calculated levels of pivot points as our targets. We can use manually drawn support and resistance lines based on previous market structure. Or, as we will explore now, we can use another powerful dynamic tool, moving averages. The goal is to create a complete if-then system that covers not just our entry, but also our exit. For example, our rule could be, if price pulls back to the parabolic SAR dots, then I will enter a short position and I will place my take profit order at the 50-period moving average. This creates a complete mechanical and stress-free trading plan with a clear beginning, middle, and end.
Let's explore the powerful strategy of combining the parabolic SAR with a moving average MA in more detail. Imagine the market is in a clear downtrend. The red parabolic SAR dots above the price act as our dynamic resistance ceiling. A key moving average, like the 50 or 100 period, below the price acts as our dynamic support floor. Together, these two indicators create a trading channel or a river for the price to flow within. Our trading plan within this channel is beautifully simple and elegant. 1. Sell when the price pulls back and gets close to the SAR ceiling. 2. Take profit when the price falls and hits the MA floor. We can potentially repeat this cycle over and over as long as the market remains in a strong downtrend. This system provides clear, objective points for both entry and exit, removing a huge amount of guesswork and emotion from our trading.
Now let's talk about the most important skill required to trade this system successfully: patience. Let's walk through a scenario. The SAR dots have just flipped to red, signaling a new downtrend.
but the price has already fallen a great distance and is very far from the new red dots. What does the professional trader do? They wait. They see the price pull back a little, but it's still not close enough to the dots for a low-risk entry. They wait again. They might sit on their hands for many hours, patiently watching the price, ignoring the small, insignificant moves, feeling no fear of missing out. Finally, after a long wait, the price makes a perfect deep pullback, almost kissing the red SAR dots. This is the A+ entry they have been waiting for. This supreme discipline is what separates a consistently profitable SAR trader from a frustrated one who is always chasing the price.
What happens if you enter a trade based on the SAR pullback strategy, but the price fails to reach your moving average target and starts to turn against you? This is where we need a dynamic exit rule. Your secondary exit signal, your emergency escape hatch, is the parabolic SAR itself. If you are in a long trade with the green dots below the price, and the dots suddenly flip to red and appear above the price, you must immediately close your position. This signal tells you that the underlying trend structure has likely changed, and your original reason for being in the trade is now invalid. You exit the trade even if it's for a very small profit or a small loss. The goal is to protect your capital and live to trade another day. This rule prevents a small winning trade from turning into a large losing one.
Let's address the other major problem with the parabolic SAR. When the dots flip to signal a new trend, the price is often very far away from them. This creates a terrible dilemma for the impatient trader. If you enter immediately, where do you place your stop loss? Placing it on the other side of the new SAR dots would require a massive, enormous stop loss, leading to a terrible risk-reward ratio. This is not a professional approach. It is gambling. So, what is the solution? The only professional solution is to be patient and wait for a pullback. If the price runs away and a deep pullback to the SAR dots never materializes, you simply miss the trade. And that is perfectly okay. It is far better to miss an opportunity than it is to take a high-risk, low-reward trade that violates every principle of sound risk management.
Like any indicator based on past price, the parabolic SAR has a slight lag and can sometimes be fooled by unusual price action. You must be aware of its technical flaws. For example, sometimes a single candle with a very long wick can confuse the indicator's calculation. You might see a situation where the recent price action is clearly bearish, but the SAR dots are still below the price, showing a bullish trend. This is because the indicator is still being heavily influenced by that one extreme low point from the long wick far below. This teaches us a valuable lesson. We can never follow any indicator blindly. We must always combine its signals with a common sense reading of the current price action. If the indicator is telling you one story, but the recent candles are telling you a different one, you must be cautious.
We have now explored one powerful strategy for using the parabolic SAR by combining it with moving averages. But this is just the beginning. The internet is filled with many other creative strategies that traders have developed using this versatile tool. I strongly encourage you to take this indicator into your own trading laboratory. Combine it with other tools you are familiar with. Test different settings for the indicator itself. You might discover a unique combination that works perfectly for your personality and becomes your own secret weapon. This process of independent research and experimentation is a hallmark of a creative and resourceful trader. Don't be afraid to think outside the box and find what truly works for you.
because you might just uncover a brilliant edge that no one else has found.
We've now reached the end of our deep dive into the world of oscillators. We've explored two distinct families of these powerful tools. First, the momentum oscillators like RSI and MACD, which measure the strength and acceleration of a trend and warn us of exhaustion through divergence. Second, the quote filter oscillators like ATR and ADX, which help us understand the market's condition, its volatility, and its trendiness. And finally, we looked at a unique visual tool, the parabolic SAR, which gives us clear directional signals and dynamic entry points. The ultimate goal is not to use all of these tools at once. The goal is for you to experiment with them, understand their individual strengths and weaknesses, and then select a small, elite handful of tools that you will master. This curated, personalized toolkit, combined with a disciplined strategy, is the true mark of a professional trader.
As a final summary of this lesson, let's first establish the fundamental difference between the two great families of oscillators. The first and more famous family is the momentum family, which includes tools like RSI, MACD, and stochastics. The job of this family is to act as a speedometer for the market, measuring the strength and acceleration of a trend. Their most powerful signal is divergence, which warns us when a trend is running out of steam and getting tired, even as the price continues to make new highs or lows. The second, less known but equally important family is the filter or condition family. These oscillators, like ATR and ADX, don't tell us which direction to trade. Instead, they answer a more critical question. Are the current market conditions even suitable for trading right now? They are our gatekeepers, protecting us from dangerous market environments.
The second part of our summary focuses on the first member of the filter family that we explored, the ATR, average true range. We learned that this powerful indicator acts as the heartbeat monitor for the market, measuring its volatility and energy level, completely blind to its direction. Its primary role in our strategy is to act as a do not trade filter. A very low ATR reading is a clear warning sign of a dead market, an environment with low volume and participation where even the most perfect chart patterns are likely to fail. On the other hand, a very high ATR signals extreme market conditions, often caused by major news or trend exhaustion, which itself warns us to be cautious of potential pullbacks or reversals. By using ATR as our first filter, we ensure we only spend our time and capital in markets that are alive and have enough energy to produce profitable moves.
Next, we explored the unique and highly visual parabolic SAR indicator. We learned that its interpretation is beautifully simple. Dots below the price signal a bullish trend, while dots above signal a bearish trend. However, we also uncovered its fatal flaw, its unreliability in sideways ranging markets, which requires us to filter its signals with a tool like ADX. Most importantly, we learned the professional strategy for trading with it. We disregard the amateur's mistake of entering the moment the dots flip, which leads to poor entries. Instead, the professional approach is to use the flip only as a confirmation of the new trend. The actual entry comes after patiently waiting for a pullback where the price gets close to the trailing SAR dots. This method provides a much lower risk entry with a significantly better reward potential.
In the final step, we understood that no single indicator is a complete system. The art of professional trading lies in combining these tools to support each other.
For our parabolic SAR strategy, we learned that since it provides no exit targets, we must complete the system by pairing it with another tool, like a moving average, to act as our logical take-profit level. This creates a full mechanical trading plan with a clear entry and exit. This philosophy of layering tools and using them for confirmation and filtering, rather than as blind signals, is the core of everything we have discussed. It is the path from being a reactive amateur to a proactive professional strategist.
I am endlessly grateful that you accompanied me on this educational journey. I hope these concepts help you to look at the market with a new and powerful perspective. I wish you all success, consistent profits, and peace of mind. Goodbye.